Hello everyone, 2019 question number 4 section 2 strategic management accounting HNDA. There are two types of material and labor in the XYZ company limited. The details of the budgeted and actual income and expenses are as follows. They give direct material cost, direct skilled labors, unskilled labors, and a variable overhead, manufacturing fixed overhead, production and sold unit, selling price per unit for budgeted and actual. But they are assuming that there are no any opening and closing stocks available, and you are required to prepare the reconciliation statement to compare the budgeted profit with the actual profit of the above company using the suitable variance. Okay, we first copy the given information in here, the budgeted and actual and the difference between variance. Next we get the unit and cost, same, and variance. Right, first they give us direct material P and Q in kilogram rupees. Right, direct material P and direct material Q. P unit in here 600 and actual 750. In Q it is 450 and 400. Right, direct material cost of P 60,000 and 67,500. Q budgeted 90,000 and actually it is 110,000. Right, skilled labor hour 1 hour rate 120, but actually it increased 150. Direct labor, unskilled labor 1 hour rate is 80 budgeted, but actually 75 per hour. Unskilled it is 80 and 75 in actual. Right, next skilled labor hour labor cost is 36,000, actually 30,000. Direct unskilled labor cost it is 32,000 and 37,500. Variable overhead 90,000 and 80,000. Fixed overhead 100,000 and 130,000. Production and sold unit 6,000 and 5,000. Right. And selling price per unit is 100 and 125. Right. In here we had 100 in budgeted, but actually we sell it 125. Right. Assuming that there are no any opening and closing stock available. Right. They ask from us suitable variance statement. Compare the budgeted profit with actual profit. Right. Now we know our budgeted sales unit amount is 6,000. Sales price is budgeted is it 100. So 100 into 6,000, it is 600,000. Like this. Actual unit is 5,000. 5,000 into actual price 125 in it is 625,000. Right. Next we can go to the variance. So first our variance, the difference between budgeted unit and actual unit. We budgeted 6,000 unit, but we actually produce 5,000. So difference between 6,000 and 5,000, it is 1,000. We enter into the statement. Okay, we finally enter it. Right. Next we budgeted our price is 100, but we actually it sales in 1 to 5. So difference between 100 and 1 to 5, it is 25. Right. Now we know our direct material unit, it is 600, but we actually we were 750. So difference between 600 and 750, it is 150. Right. In price it is budgeted 100, actually it is 90. So difference between 100 minus 90, it is 10. Right. Q, it is unit 450 and for actually 400. 450 minus 400, it is 50. And price, unit price 200 and actually 275, it is difference 75. And the difference between skilled labor hours 300 minus 200, it is 100 hours. The unit rate difference, skill, direct labor skills budgeted 120 and actually it 150. So difference between 120 and 150, it is 30. And unskilled 400 budgeted and actually 500 hours. The difference between 400 and 500, it is 100 hours. And unit rate is budgeted 80, but actually 75. Difference between 80 and 75, it is 5. So variable overhead budgeted 90,000 and actually 80,000. Difference between variable overhead, it is 10,000. Fixed overhead budgeted 100,000 and actually it 130,000. Right. Our budgeted profit is 192,000 and actual profit is 170,000. So how do we get budgeted profit? So, so sales revenue 100,000 minus total of our cost, right? Next we prepare our statement. First, budgeted profit, it is 192,000, and for our first variance, it is the price variance. Our price variance is 25,000, and we actually produce 5,000 units. So our variance amount 25 into 5,000, it is 125,000. Next, our variance, price volume variance. So price volume variance, it is 1,000, and here it is 1,000. How do we get 1,000 into our budgeted price? It is 100,000. Next, get the direct material price variance. So our direct material price variance is, it is 10. So 10 into our unit 750, it is 7,500. Next, direct material Q price variance. So price variance is 75 into our unit, actual unit 400, it is 30,000, right? Next, direct material usage variance, it is 150 actual into our hundred, it is 15,000, like this. Direct material usage Q, so variance is 50. So 50 into 200, it is 10,000. Next, direct labor skilled efficiency. How do we get? It is 100 hours into 120 budgeted rate, it is 12,000. Next, direct labor skill rate variance, it is 30 into 200 hours, it is 6,000. Direct labor unskilled rate variance, and unskilled rate variance is 80 minus 75, it is 5 into actual hours, it is 500, it is 2500. Direct labor unskilled efficiency variance, the difference is 100 hours into 80, it is 8000, right? Likewise, the variable overhead variance, it is 10,000. And finally, fixed overhead, the 100,000 minus 130,000, it is 30,000. So finally we get the actual profit. So budgeted profit plus budgeted profit plus the plus value and minus this column, get the value sum of and minus address, it is 170,000.